I, I am our chair of Women United. So thank you so much for joining us for our 2026 Women United Financial Panel, Financially Fierce Women Owning Their Financial Wellness. I love that title. So, for those of you who are new to this group, Women United is a volunteer led women's donor network within United Way of Dane County. And I love this group, and it is near and dear to my heart because we align ourselves with the mission of United Way to advance family well-being in our community. So, if you are a member, I would love you to drop a heart in the chat so we can recognize you. Also, if you are not a member, we are just loving that you are here, and let us know if you would like to connect with someone afterwards to learn how you can get connected or tied with Women United. So our members are really driven, and we're all deeply committed to uplifting others. And collectively, we invest in women and families so they can find pathways towards financial security. I love the fact that we opened up asking everyone today about just your financial goals and things that you achieved this past year, because this is uplifting. And we want to ensure that we continue to uplift the work that we're doing and talk about a lot of the outcomes that we've achieved through our work. So when we look at housing, 947 households avoided eviction through case management and financial assistance and remained stably housed after 1 year, which is a really strong indicator of lasting impact. And obviously, it's really important for us to make sure families are housed. So I love that. Secondly, around home ownership, which we know is really, really important. And we just saw in the chat, we have many who have just attained their own homes. So 46 women with children prepared for home ownership last year by qualifying for down payment assistance, which is awesome, and completing a home ownership readiness course. And 13 of those households actually gained home ownership, which is amazing. So again, that is helping us make some more inroads within the community. And lastly, around workforce, which is super important. Last year, our investments in workforce strategies helped 430 under or unemployed, individuals gain new or better employment, with 68% earning $18 an hour or more, which is great because we want to ensure that we're helping people get jobs that have livable wages. So those are commendable. I would say let's give ourselves a round of applause for actually helping to make those contributions and make Dane County better for women and families. But how else are we helping other women in Dane County? So we plan year-round activities to engage our members and corporate partners. And our Women United at Work program is a coalition of many different corporate women's groups where we bring together many members quarterly to support their efforts in engaging and developing women in the workforce. So I would say if you have a women's group within your workplace, we'd love to connect with you all. We'd love to introduce you to others who are leading in this work, share ideas and share resources, etc. So definitely put it in the chat if you would like to get connected. And finally, our volunteers create thoughtful time and space for our members to gather and learn from each other. Our donor network is vast, from CEOs and civic leaders to small business owners and young professionals. So we host virtual and in-person events that support your development and financial security while helping you form new and meaningful connections with other community like-minded women. So we have many different events that are coming up in 2026, and we would love to see you at all of them if you can. So we have our 13th annual Women United Brunch, which is taking place on May 13th. And this is where we fundraise for programs that help women achieve financial security and honor a local woman in philanthropy. And I would say it's my favorite event to attend of the year. And last year, we were so proud to have raised over $100,000 to support more women in Dane County. And we still have a need, I would say, for this brunch coming up in May for sponsorships, table hosts, and in-kind donations for our silent auction. So if you are interested in not just attending, but also contributing to this brunch, please let us know, and we'll be sure to get you that information. And also, just to add, later this summer, we're going to host a member appreciation event at Concerts on the Square. and a speed mentoring event in September. So please be on the lookout for those events. And if you would like to receive some more information, again, you can feel free to put your information in the chat if you don't know how to find it, and we will make sure we get that to you. So ultimately, I'm inviting each of you to join us in our mission at Women United. So we are, while we're doing some great work in the community, we're also trying to make sure that we are providing an engaging and great just connection experience for all of our women here in Women United. So we continually want to level up our experience and our impact in Women United. So we're asking members to join us at the leadership giving level, which is 1,000 or more annually, or at the step up level to grow your gift over time. And I would say this is more of an investment, but it's investment that helps us sustain our efforts to reach more women in Dane County. And we also believe that every gift matters. So even if you're not quite ready, I would say, to make that investment, we are inviting everyone to give an annual gift that's meaningful to you to help us to continue to drive this work. But either way, we have a lot of different opportunities to plug in. So if you're interested in giving a gift and you're interested in kind of being all in with Women United, we welcome that. You can definitely drop a link in the chat. And if you've already made a gift for the year, and if you aren't sure what you selected or what you kind of filled out on your interest form, you can definitely connect with us further right after this. So we're excited to gather this morning with our amazing network of experienced Dane County women who are ready to empower and inspire our financial wellness. We host a financial wellness panel every year because we know there's always a desire to strengthen our financial literacy and get us closer to our goals. We want our members attending today to have tangible tips and ideas for how to achieve a stronger financial future. And we're excited because we have some very experienced panelists who come directly from our donor network, Women United members and financial experts who are all focused on helping you build greater financial confidence and well-being. So I want to thank you all for joining us today and thanking you in advance for providing your questions and topics of interest when you registered. We'll get started with questions for our panelists, but I want to encourage you all to add your questions and thoughts in the chat. Engagement and connection are words for the day. We'll also have some time at the end of the panel to really talk through any of the questions you have, but also if you would like to be connected with any of the panelists or receive any additional information, we'll be sure to get that to you. So before I hand it over, I just want to introduce our moderator, Kim Spanum, who is our CEO and president of Summit Credit Union that everybody knows because they have a very strong brand and very lengthy community outreach here in Dane County. So Kim is a fierce advocate for women's financial security and a Women United member. So we want to thank Kim for helping us put together this program and moderating this discussion. So Kim, I will hand it over to you.
Thank you so much, Deidre. It's such a pleasure to serve with you on this panel today, and thanks for the introduction. And thank you for serving as the United Way chair of Women United. Women United is just a powerhouse group of women. I'm so honored to moderate today's panel. As you mentioned, the title, I love it too, Financially Fierce, Women Owning Their Financial Wellness. This topic, I have spent most of my career working to improve women's financial security, and our purpose at Summit is to help women and their families become financially secure and trying to, really avoiding poverty in retirement, because women are 40% more likely to retire in poverty than men. So when I think of financial wellness for women, I think about the incredible power of women here in Dane County and this group, and the United States and worldwide too. Women make up 70 to 80% of all purchasing decisions, and yet it was just 60 years ago that it was perfectly legal to pay women less than men for the same work. And while the Pay Equity Act made that practice illegal, and really companies are doing a pretty good job at paying women and men fairly for similar work, still some spots to clean up yet with that, but women are still earning 83 cents for every dollar men make. So what what is creating that? And really the challenge is the lifetime earnings gap. And so for many reasons, women are more likely than men to end up in poverty in retirement, whether it's because we take time away from the paid workforce to care for children or other family members, and companies make it difficult to re-enter and to re-enter at the level in which we left. Fields traditionally held by women are undervalued. We tend to live longer than men, making a lot of the information today so relevant because we have to be even better than men at managing money. And then, it's harder for women to obtain higher level positions. So more and more women are demanding equity in money, and more businesses are taking steps to end the wealth gap for women. And it's something we are very much focused on here at Summit, and I'm really proud of that. When women are financially secure, we know families, communities are stronger. We all benefit when women have the tools, knowledge, resources, and confidence to build wealth. And that is why I'm so excited that we have assembled this insightful panel of experts. And we will be sure to leave some time at the end for them to address your specific questions. But there are so many good points and pieces of information that our panelists have to share with us today that we're going to just dive in here. So the first panelist that I would like to introduce is Brooke Weitzer. And Brooke is a Women United Council member, and she's here today as our tax expert from Baker Tilly, which we're very excited and fortunate to have her join us today. We appreciate you taking the time to educate all of us on the vast tax law changes. And then we also have Jen Ridley Hansen, and she's a certified financial planner and certified divorce financial analyst who serves as the director of wealth planning for Slate Stone. Jen has been a previous panel member, and we so appreciate, Jen, your willingness to share your expertise on how couples can more effectively navigate financial management and challenges, and also navigate when things don't turn out quite the way couples might have planned. And then Melanie Lee Thompson is a member of our donor network and Lead United Council. I've known Melanie for many years at her time as a financial educator at Summit. She currently is a financial literacy educator with Associated Bank. And thank you, Melanie, for taking the time to share with us the impact of money challenges on our well-being. All very important topics, and altogether, this is just going to be a great next hour and 15 minutes. All right, so Brooke, let's start with you. Let's talk about the 2026 tax law changes. And I think you're going to be sharing a PowerPoint slide, so why don't we just dive right into that and start out with the first question of what impact does the new law have on us?
Thanks, Kim. So I'm going to be going through some tax items today at a high level, and it's a lot easier to visualize for some people. So I thought we would just walk through the screen for the first couple questions here. Firstly, on the tax legislation update, I'm going to be focusing on the individual updates. There are a lot of business and trust and estate and those types of updates, but I really want to focus in on your individual personal situation. So the first one is the tax rates and reduction in the brackets were made permanent from our 2017 TCJA. The only updates to this was that the 10 and the 12% brackets, the incomes brackets in there were overall increased, making your overall effective tax rate lower, just slightly. And then the top tax bracket of 39.6 did not come back into play starting in 2025. There's also some broad statements out there on what you're not being taxed on going forward, but then I want to dive into the details of what that actually means. So the first, broad stroke out there was that there was no tax on car loan interest. And what that really means is for tax years 2025 through 2028, you get a deduction up to $10,000 on a filed tax return for a vehicle that's newly purchased with U.S. assembly. And you would have to get certification from the dealer and then information from your lender to fill out your tax return. The next broad statement was there's going to be no tax on overtime. And what that actually means is that for tax years 2025 through 2028, you can get a deduction up to $12,500 for single and 25 for married filing joint on non-exempt hourly employees for that time that is on the overtime. So if you get paid time and a half, it would be that half percentage on there. You must still pay payroll taxes. So this is just the income tax portion that you are saving on that. The next broad statement was no tax on tips. And again, that's for tax years 25 through 28. And that deduction is $25,000 annually on cash tips for those employees who are customarily tipped. So you got to think of your bartenders, your waitresses, those types of people. So it can't be that all of a sudden you're an employee at an accounting firm and you get tips as part of your wage now. That's not what they're really looking to do. They're really looking to hone in on those people that were previously received cash tips. And again, you must still pay your payroll taxes, so Social Security and Medicare, but this is the income tax portion of it. On the Wisconsin side, Wisconsin does not conform to allow you to have a deduction on your car loan interest, but the Wisconsin Assembly has passed a bill to allow you to have no tax at the Wisconsin income tax level for overtime and tips, but that's still pending because it still has to go through the state Senate right now. So more to come on that. Next one is the permanent increase to the standard deduction. It was initially set to expire after 2025, but beginning January 1, 2025, married filing joint, you'd get a deduction of $31,500 and single $15,750. Personal exemptions were previously exemptions that you had at a set amount taken by each one of you claimed on your tax return. So taxpayer, spouse, dependents, times that set amount, and you would get a deduction for that. Because they increased the standard deduction, they went away from the personal exemption. A new deduction out there is the senior deduction, and that's for taxpayers age 65 or older, and that's a $6,000 deduction for a qualified individual, and it does have income threshold set with it. Now we're going to get more into the itemized deductions section of this. Previous legislation capped the state and local tax deduction at $10,000, and that was set to sunset as of December 31st, 2025. This new tax legislation retroactively increased that amount to $40,000 for 2025. That does have phase outs for higher income earners, but it does not get phased out below that $10,000. And that will revert back to the 10 instead of the 40 beginning in tax year 2030. There's a qualified resident interest deduction that limits the amount of mortgage interest that you can take up to the first $750,000 of home mortgage acquisition debt. And the home equity debt is not deductible unless the proceeds were used to buy, build, or substantially improve the taxpayer's home. A large change that did happen was to the charitable contributions. So on the, if you itemize, the new floor is out there, and that states that only charitable contributions exceeding 0.5% of your adjusted gross income will be deductible. And that's starting in tax year 2026. So for example, if your adjusted gross income was $150,000, your floor now would be $750, and only charitable contributions exceeding those $750 are deductible. You basically lose out on that first threshold up to that $750. They have a new ceiling put in place for cash contributions of 60% of your AGI and non-cash contributions at 50% of your AGI. If you are somebody who does not itemize, you can now take a charitable contribution of $1,000 for single taxpayers and $2,000 for married filing joint for tax years beginning after December 31st, 2025. And this must be for cash donations made to a public charity. Still going with the itemized limitations, there used to be a PEAS limitation out there that limited your itemized deduction at an overall level, subject to high income earners, basically. They went away with that and permanently repealed it, and they put a new limit on there. And this new limit basically is that you cannot take an itemized deduction above 35% if your effective rate is higher than that. So it's a haircut of 2% because the highest tax bracket is 37%. They did permanently terminate the miscellaneous itemized deductions, and those are things like your investment fees. And so those had been suspended since 2018 and now are made permanent going forward. There is a new tax deferred investment account. If you have a child that was born between January 1, 25 and 12/31/2028, it's a pilot program that allows you to set a retirement account for children, and the federal government will contribute $1,000 to this. There's a new form that I just got an update for today, Form 4547, that you can fill out, and they want you to do that with your 2025 filed tax return. And I've also seen a lot of things in the news about companies or public employers or public companies also allowing to contribute to that. So if you kind of look for this on the internet, there's other things besides the people besides the government that will contribute to that tax-free. There's a 529 account, and a 529 allows you to save money for your children over the years, and it can grow tax-free on the growth of that. And then when you pull that money out, that is also tax-free as long as you use that for qualified higher education. So think college. Now they're expanding that, and they're saying that you can also use those funds for K through 12. So it's a good way on the Wisconsin side to get a deduction for this amount, and then you can let the amount grow throughout the years and pull it out tax-free. Okay, so that was a lot to throw at you, but we're going to now go into just one of the sections because it is such a large change and it does impact your charitable contribution giving throughout the year. So we're just going to dive a little deeper into that charitable contribution. So again, what we're talking about is that charitable contribution floor. So the example that we're going to talk through is if you're married filing joint on your tax return and you've got adjusted gross income of $150,000 and you've got other non-charitable itemized deductions of $20,000. If you remember from the previous slide, the standard deduction is $31,500. We're not going to adjust it for any inflation or anything like that. So our charitable contribution floor is $150,000 times the 0.5% or $750. If you think about the itemized deductions and what makes up your itemized deductions, there's medical and dental expenses. That's really capped because you have to go higher than these other levels. And so a lot of people don't have that on their return. A lot of people do have taxes paid. So that is your state and local income tax. That's your real estate taxes. So let's say we're going to make up that $20,000 of non-charitable amounts. And so the other amount that we talked about that was an itemized deduction is mortgage interest. So let's just say round numbers, you paid in taxes and you've got mortgage interest expense that you can deduct to get to that $20,000 without having anything related to your gifts that you have donated. Under this new legislation, if you think about it, you've got your standard deduction. So that's a free deduction, married filing joint. You don't have to have anything related to that. And they give that to you of $31,500. We've got the non-charitable itemized deduction of the $20,000 that we just talked about, the state and local income tax and your mortgage interest. So in order for you to itemize, because you want to either take your greater of your standard deduction or your itemized deduction, you would then say, okay, I only need $11,500 of charitable contributions to really itemize versus using the standard deduction. Well, now we have to put the charitable contribution floor into that, and that's that $750 that we talked about. And then if you don't itemize, you also get that above the line deduction of that $2,000 for married filing joint. So in order to itemize, instead of using that standard deduction, you would actually need to give charitable contributions of $14,250. So the rules there can be very nuanced, and hopefully if you get these slides, we'll send them out after this, that you can take a deeper look at it and say, look at what's going to be beneficial for you versus the standard and itemized when you take in that new floor there. Another new change for the charitable contribution was that you do not have to itemize, and now you can get an above the line deduction, they call it, of $2,000 of charitable contributions. in which you do not have to itemize, but you get the benefit for. So if you give that full $2,000, you get a federal tax savings of $270. You save on your taxes. So your net cash outlay then would be the $1,730. So there's two different ways now in which you can get benefit for giving charitable contributions. So now that we're done with the technical part of it, we can move on to the easier part and take a deep breath here and just give you some tools that are out there on the IRS website that can help you with the upcoming tax season. If you just type into Google irs.gov, this is the website that you will see. And they do a good job of trying to help you with your tax returns and give you different tools that will benefit you. So this is the top of the page, and I'm going to walk through some of the tools that you can utilize. This is the bottom of that page if you scroll down on that website. And there's different things of getting your transcripts. You can make a tax payment. You can get a PIN, which I'll talk through. And then there's also this other section over here on the right that says use your tax tools. The first one at the top, the very top, is they do offer free e-filing. So you can actually file your federal return online without having to pay. There's a couple different options there, which you can utilize. The next one, and what I would ask you, this is going to help you greatly if you go in and you create a new account, and it's called ID Me with the IRS. I highly recommend going on there and doing that. This is what it looks like once you log in. You can basically go in there and you can check to see if you have a balance due. You can check to see if you made estimated tax payments. You can go back and you can actually check your tax records from previous years and to make sure, okay, everything's fine. I'm on good standing with the IRS. You can see if there's any notices or letters that got sent to you. And it just kind of helps you through understanding instead of having to call the IRS and talk to somebody live, which can get pretty painful, and I'll talk about in a little bit. You can actually go online and just check all of your years and check all of your balances, and it helps you do that. The next one is get an identity PIN. And an identity protection PIN is basically a number that they give you, and you need to then input that into your tax return. In this world where your social security number is all over the place and you have identity theft happening at all times, you can see that where people actually try to file a tax return using your social security number to get your refund. So somehow they're able to get that, they're able to see your wages, they're able to see your withholding, and they file a tax return and they request 100% of your refund. So it can take a lot of time to go and track everything down and get it cleaned up. And whereas if you go online, you get this PIN, put it with your tax return, and now nobody else can file a tax return on your behalf because they would need your PIN in order to do so. So that's something else I recommend there. The other tools that would be helpful on the IRS website is this wage withholding calculator. So if you're somebody who wages make up 75 or 100% of your income and you're constantly having to pay in, you can go in there and use this calculator to say, hey, maybe I should adjust my withholdings, and this is how I should do that. There's other tools out there for the credits that are available. The top ones that I saw was the Earned Income Tax Credit eligibility, the Child and Dependent Care Credit, and then the Adoption Credit. So again, they help you kind of just do a little bit more research to say, hey, am I available to have this? Can I look into this and claim a credit or update my withholding, all that type of stuff. I know that we only talked about the IRS, but I just want to point out that Wisconsin has a lot of tools also. If you just Google Wisconsin Department of Revenue, they have their page that comes up and they've got a bunch of tools on here, and they also have an online account. You can do the same types of things. You can make payments, you can check your balances, make sure your return was filed, all of that type of stuff. So then.
Okay. All right, let me jump in here. Brooke, oh my gosh, you have just shared so much information. My head is spinning, having not dived into these tax changes myself. So, so thank you. I'm sure others may feel the same way. So, I'm just curious, have there been any changes at the IRS that we should be aware of this tax season?
Yes, I would say that there was a lot of legislation that passed. but the funding that has been sent to the IRS has been cut by 50%. So that was roughly 42 billion in cuts to the IRS after a year in which there's sweeping tax legislation. So what you'll see is that the personnel count at the IRS is lower than a normal year, and the systems that they're using aren't as up to date as they should be when they're trying to implementing this new tax legislation. So what we have seen is some fake notices that have been going out to the from the IRS. So that's where I'm saying that online IRS account is going to be so helpful in going on there and saying, oh no, I'm getting a notice from 2024, but it says on my online account that I'm set, I'm processed, and I don't owe any taxes. So I would say it's going to help you to really, check that out to make sure there's nothing that comes to you that's not fake or erroneous that you don't need to worry about. Some of their changes that happened is the USPS changes their postmark rules. And so it used to be that you would go to the post office, and whenever you handed over or put in the mail slot, the mail, that was the date that said that it got sent. In the tax world, IRS has these rules. If you don't have something filed by April 15th, you can get penalties, you can get interest, you can get you can get a lot of nasty notices, again, because you have not filed them on time. Well, with this new postmark rule, they're saying the USPS is not postmarking it until they've actually filtered through some of that mail, and that can take up to 3 days. So if you are somebody who's still snail mail, I call it, your return, you want to get to the post office, either hand it off to somebody or get that certified mail so that you can have it postmarked by the due date.
Yeah, those are really good thoughts around that. To continue on, I was just like, wow, we've got to be paying attention to this.
Yeah. there's been a lot of updates. And then also, as of September 30th, there was a new rule that the IRS was no longer accepting or issuing paper checks. So if you were getting a refund, you need to make sure that you're putting your bank account information on there, because otherwise your refund could get stuck in limbo. They're working towards fully implementing that out, so it's not 100% there, but it better be safe and sorry than wait 6 months to get a refund that you're really counting on. Yeah. There used to be also an online account that was called EFTPS, but they've completely canceled that. So if you were somebody who was ahead of the game and already had an online account, they changed it so now it's ID Me. So you should really go on and set that one up.
Yeah, those are great tools. And as you said, in all of the fraudulent world that we live in, really important that we know about those things and do that. Are there any suggestions on how to reduce our stress during tax season? I mean, it seems like there's so much to know and so many things that, I think people get worried that they're going to do their taxes wrong or something's going to happen or the IRS is going to come after them. Right. What would you suggest?
So I would suggest make sure and stay organized throughout the year. So if you're giving charitable contributions throughout the year, make a folder on your computer or have a paper file at home. Make sure you're always getting those pertinent tax documents into one place. So at the end of the year, when you go to file your tax return, I always put it in this folder so I can go out and look at that. That online account that I've been talking about throughout the presentation. And if you can e-file your return using the free services either on the IRS website or the Wisconsin website, that's going to reduce any of the calculation errors, the input errors, all that type of stuff. They've automated a lot of that. They can scan your W-2 and it can go in, so you're not hand populating a lot of those things. I would also say don't automatically accept an IRS notice because of the things we were talking about. There's some fake ones going on out there. So make sure you do your due diligence before you respond to something or just pay an amount due that might not actually be correct. I would say don't procrastinate. Your tax return amount of tax is due by April 15th, but you have until October 15th every year, as long as you extend your return, to finalize return. So just make sure that you're getting all of your information in, all of your W-2s, all of your 1099s, all of that type of stuff. Make sure you have everything that you had previously or open new accounts before you finalize that tax return. And I guess when in doubt, ask a professional too. So if you have a lot of these things going on, just, seek the right professional that's going to help you with your situation.
Absolutely. All right. Well, thank you so much, Brooke. And We just ended on the idea around stress, and I know there's the tax stress. There's also financial wellness impact stress and mental health, and that's what our next panelist is going to talk about. So, Melanie, it's great to have you here. And let me start out with a question for you. How do you define financial wellness, and why does it matter in everyday life?
Yes, well, thank you, Kim. And it is such an important topic. I'm so glad we're having this conversation today, and what a great tee up here from Brooke as well, because there is such a misconception when it comes to financial wellness. And some people think, well, I have a retirement account, I'm financially well, or I'm managing my debt just fine, so I'm just fine. But it really is more than this. And a lot of the financial education sessions that I do on a frequent basis, I actually talk about the actual definition because it's super empowering. So I wanted to share that with people as well. That financial wellness is being able to meet your current and future financial obligations, feel secure in your financial future, but it also lets you make choices that allow you to enjoy life. And I love that piece because it doesn't say anything in there about being fully restricted. And so when you ask me about my financial wellness, I really think that it's more than just numbers in a bank account. It's about feeling in control of your money and understanding your full financial story. And that is just a really important piece there, is like understanding your full financial story. And this is really knowing like what your income is, what your expenses are, what are the decisions that you're making around money, and how are you being intentional when it comes to your financial choices. And this could also tie back to financial goals. And I know that we'll dive into that here in a little bit, because financial goals with purpose makes your budget more meaningful. And budgeting doesn't have to be such a taboo or a taxing topic. It can actually be really empowering. And I know that we'll cover stats as well. That was one of the things that you mentioned here when you were starting out, Kim, because it is so alarming, but it's so important at the same time, because financial wellness really matters every day when you're really leaning in to reduce stress when it comes to paying bills, planning for emergencies, how you're spending, but also most importantly, those unexpected expenses. And I think that's something that really throws people for a loop, is that those unexpected expenses generally create more stress for people. And when you're intentional with your debt, thinking about how you spend, how you plan for your purchase, and knowing the impact of financial decisions that you make today, that can really move into the future. And it kind of creates this spiral if there's no plan. And so I was thinking of different examples for myself of like being mindful, and credit card spending could be a good example, knowing that somebody has a plan for home ownership, maybe in 2, 3, or 5 years. And understanding how they're making spending habits right now, knowing what debt balances they're carrying, or even what their debt to income ratio is, all play a role into really achieving financial wellness. So hopefully that was a good example there, along with providing some of my own personal information on what I feel like financial wellness is.
Yeah, there's just so much to talk about it with this topic. And you're right. When we think about unexpected expenses, a lot of times people feel like I just got my savings account to where I wanted it to be, and then my furnace went out or whatever, and it feels so much setback for that moment. But that is why we save in some respects, is because we know those things are going to happen in life, I guess. But so when you think about financial stress, how does that show up in people's lives? What impact can it have beyond just the numbers?
Yeah, it definitely can show up in a variety of ways. And I'm certainly experiencing this just recently with a family member as well. And, it really can take a big toll on our mental and our physical health. And I don't know if anyone on here has really heard of the 8 dimensions of wellness, but it can create this ripple effect of affecting how we feel emotionally, even our energy level, whether it's at home, it could be even a focus at work, or how we respond in relationships. And, I love that definition when we talked about in the beginning of being able to enjoy life, but it can really take the energy away from being able to enjoy life when we let this financial stress take over. And it can definitely be driven by a lot of factors. A lot of what I hear is that it's driven by inflation or added debt or increased cost of living, a lack of savings. Really, it comes down to financial planning, but some of it too is being a lack of communication and a lack of setting financial boundaries. And so what I've seen and what I talk about a lot in the sessions that I do is that it can show up, internally, but it can also show up externally. And some of that could be with migraines. I know high blood pressure, anxiety. If you actually look, do a Google search on it, there's quite a bit of stats out there and a matrix also that will show that, it's just not loss of appetite or just low energy. I mean, it really can, lead to long-term financial challenges. And I'm sure some of us on the session today could probably attest that some of these factors we might have even experienced ourselves. And I think for myself, back to a time, when I was early into my financial career where financial stress was really at an all-time high. I was, raising 3 kids on my own and weathering the storm of financial hit after financial hit. I was trying to think back to everything that was going on. And it was car repairs back to college expenses for myself as a returning mom, unexpected surgeries that piled up medical bills, and even some of the uncontrolled spending. Because truthfully, I was raised with a lack of financial education. And so when an emergency hit, I was used to charging on a credit card, or when I was invited out, I was used to charging on a credit card. And back then for me, it wasn't about creating a plan of how to get out of debt. It was more of that lack of awareness that actually kept me there. And when I talk about those impacts, frequent migraines became a thing for me. Anxiety was really big for me when it was time to sit down and write out bills, and that extreme stress when another storm hit unexpectedly, really played a role and took a toll on me. And I can tell you, even raising kids who are now all young adults on their own, I know during that time of my life, it actually was very stressful, and my kids actually probably felt that in presence as well. And so part of this is with over time, learning how to better plan. So talking about emergency savings and budgeting proactively, really what that does is it reduces that financial stress, but it also reduces that mental toll. And so, I really think that protecting our health and having peace of mind when life throws us a curveball can really reduce a lot of those additional things that can result internally or externally.
Yeah, and of course we want to try to minimize that as much as we can. And so what strategies would you put into place? What can you tell us that that could help us reduce financial stress and build that financial long-term wellness that we all seek?
Yeah, well, I laugh at this a little bit because I have a little bit of a pickup line that I say that, I tell people all the time, every year when you do a checkup on your health with your doctor, you should also do a checkup on your wealth. And that really includes meeting with financial advisors of all sorts, right? Financial coaches, it could be retirement advisors, even those that can help look at a budget, help you review debt, set financial goals, review credit. I mean, all of those things kind of tie into that wealth piece. And one of the best places to start is really looking at your budget. And if there are people on right now that have really never looked at it or put it on paper, and it can be this scarce thing because sometimes people are like, I need to, print out a budget worksheet, or I have to put together this massive spreadsheet. That can really be intimidating, but it can also be really eye-opening. And it really is looking at the meat of everything. You're looking at subscriptions that you're tied to, how you're spending when it comes to amounts you're allotting for food. How are you looking at transactions and getting a really big picture snapshot of your financial obligations, which would be all of those debts and those expenses. And then also really laying those out. And you can do this a number of ways. I know that there are a number of financial institutions that will have tools and resources, but this is really just writing out, who do I owe? How much do I owe? What's my interest rate? Am I on any promotional balances? What is the ending term? What's my game plan for that? And so that is what I would say would ultimately be number one, to really look at what it is that you're paying on, because there is such a lack of awareness when people, there's an assumption of what they pay, but there is an actuality. And so a lot of times when I'm talking with people, I say, give me an estimate of what you're paying on X, Y, and Z. Now let's actually look at it. And I think sometimes that can be really alarming. And a piece of that financial wellness too is, knowing confidently what each of those pieces are. Another piece of that would be building an emergency fund. And some people feel like, and I've heard a lot about this with, the Dave Ramseys and others as well, is that, you need to have a specific dollar amount, whether it's 10% or 6 months of your salary or 6 months of expenses. To me, really, it's just about starting, and even small contributions matter. And if anyone's listening who is new to this, really it's starting small and building a habit so that it feels enjoyable. Because when we set these big audacious goals of I want to save XYZ by this amount, but we actually don't back into it, that can really make it unattainable, unrealistic, and it's not fun. And with setting financial goals, this is something that a lot of people don't think about when they're building financial wellness. And it's such a key component because when you tie a why to what you're doing, why you're creating a budget, why you're, what that purpose is behind this, it is more enjoyable and more fun. And it starts to actually transform habits into a repeat cycle. Instead of it being this, I get paid, I have bills, now I'm stressed, I get paid, I get bill, have to pay my bills and I'm stressed. It gives you more clarity and motivation around what you're doing. And I loved in the beginning here where that question was posed around financial goals because I could feel the energy from all of the people who were putting in the chat the goals that they meant or that they met, excuse me. And there had to be purpose behind all of that. And so when you break down goals into SMART goals, and we've heard about this, high school, college, where you break them down into specific, measurable, achievable, relevant, and timely. This will give you peace of mind when it comes to planning for the future or weathering the storm of unexpected expenses. I think of what does that actually look like for someone? And so just imagine if you're wanting to create an emergency savings, let's say, for example, of $1,500, and you want to accomplish this goal in 1 year, what you would need to do is you need to back into your payroll. So how many times a month are you getting paid? And how much do you need to save when you look at a 12-month calendar? And so if $1,500 is the goal, ultimately it's $125 a month, and then you need to break that down by payroll. But the other key piece to that is the action, and it's setting up an automatic transfer to be able to make that happen with the intention of understanding why you're doing this and without tapping into it until it's needed. And I think another piece to this also, and the last piece of this question, Kim, would be growing education and skill. Whether you grew up with financial education or not, continuous education really does build financial confidence. And I think about myself, as I mentioned, growing up without any sort of financial education. And also, too, getting connected to a financial coach or a financial institution, because when you have someone that can give you some guidance, maybe even provide some perspective and be a supporter, that can really make a big difference. And so they really do help you look at your budget, maybe hold you accountable in some way, but ultimately reduce some stress to increase that confidence overall.
Yeah, thank you. And oftentimes just stating it too. So that this is what you want to do. Make a really good point about starting small and build up, and getting started is such the key. So when you think about, and you mentioned you didn't have any financial education or understanding at different, earlier on in your life career. When you think about how you navigate, or how we could navigate conversations about money with children or our partner or friends, sometimes friends ask friends for advice. What are your thoughts around that?
Yeah, it's definitely honestly such an important question that I think that there isn't enough conversation around, because money is a sensitive topic. It absolutely is. And learning to communicate around it really is such an important piece, right, to building financial wellness. And this is something that I've built skill with over time, not only with me personally as an individual, an individual managing finances, but also to my kids and also to a spouse now. And, it can really come down to setting boundaries and really understanding what's important to you and the why behind what you're doing, like as I mentioned with the budget. And, sometimes it's having some honest conversations and taking a step back without necessarily having to react, poorly or harshly, but in being intentional around why you're doing what you're doing. And I thought about an example of this. I remember when my kids were growing up, and, when they're young and you take them to Target or you're going into Walmart, and there's always the aisle or the toys that, you want to go into the toy aisle. I think some of that can be, especially when there's asks from children. It could be maybe being, open with communication and sharing, knowing that there might be a toy that may not be used, or it's a quick fix, to buy. Maybe it's more of involving your kids in sharing more of your financial story, and being open about that. Maybe it's even communicating with a friend who might be inviting you out to do something, but knowing that, it's going to actually push you outside of your budget. And while it could be a great experience, that might be something that in the long term could create some additional anxiety and stress. And with these conversations, the more practice that you have, no matter how old the person is, it can really help build confidence and clarity around the financial choices. And, I thought about a situation recently where I was invited to a concert. And while I loved to go, I wanted to instead work on paying down my car loan. And with that, it's being open and saying, I really appreciate the invite, but right now I'm focusing on a financial goal to pay down my car loan. Would you be open to having a movie night at my place instead? And so it looks a little bit different for everyone. And, I want to share too that it's important to not feel like you have to justify why you need to communicate boundaries or why you're focusing on financial goals. Even with a spouse, this can look a little bit different. And, my husband and I are a great example of this, that we have very different hobbies. And I'm a big proponent of having his, hers, and ours approach. And it really does help us stay aligned in honoring what our individual interests are. At the same time, like we really do understand when we have joint obligations like planning vacations or household expenses. And actually, here's a good example. We just listed our house this week. We're making decisions and having an equal discussion, but we're also being intentional and transparent about money that allows us to stay aligned and really reduce conflict so that we're making choices that we feel good about. And I think about me too personally in this. Oh, sorry about that. About these conversations becoming easier and easier.
Yeah.
It's not about saying no, but sometimes we do need to reframe, how we feel so that we're financially aligned overall.
Yep, yep, yep. And I think Jen's going to get into some of that more specifically too. So just we're a little bit over time, but because I want to get into Jen's conversation too. But if you could just quickly give me your thoughts on the latest research and statistics, what it tells us about women experiencing financial stress and confidence today. If you could just give us a couple of those, that would be great.
Yeah, absolutely. And I think this is something that I'd highly suggest doing research on because the stats are out there as well. But nearly 93% of women feel stressed about money. And this is even higher than the overall stat, which is 91%. And that was actually announced by Bright Plan in their survey, and they'll have a new one coming out. And, of that 93%, only 44% of women feel confident in saving for emergencies, and only 36% actually feel confident when it comes to saving for retirement. And so, those are some pretty alarming stats, and that's why this is such an important topic. And I think the other thing to share too is that 65% of women still report feeling that finances are the top source of anxiety that they carry. And so really being aware of, the stressors that show up every day, and figuring out ways to manage and reduce that.
Yeah, fantastic. Okay, well, thank you so much, Melanie. I'm going to turn it over to Jen. She's going to talk about managing finances with a partner. And so, Jen, I'm going to start out with a question around the challenges that couples face when dealing with money. If you were to summarize that, what are some of the things that couples face together?
Yes, great. Yes, that's a great place to start. And I think a lot of it really comes from what Melanie just shared, right? So we each have our own ways we were taught about money or not taught about money as a child. And so I think we have these things called a money script. So script is kind of the story you tell yourself in your head. I've heard people say, I'm just bad with money. I'll never have money. I'll never figure out money. I don't understand it. I don't like it. And so I think, even think of things like taxes. We started with that this morning. There's a lot there. And I think people can say, I just don't want to spend my time learning this, but certain things we do have to take care of. We do have to pay our taxes. We have to manage our finances. And so I think for people getting together as a couple, you have to understand that your person you're going to be marrying or you're putting your money together with has their own background. And so they learned about money however they were taught. And so either parents taught their kids all about money and were great examples and did everything right. Or we have people who, their parents fought about money. Fights about money might have led to their parents' divorce. That's very common. So you talk about the stresses and all the things that Melanie just covered. That's financial stress can oftentimes lead to divorce. And sometimes a parent may have made a poor financial decision that also could have led to a divorce, and that also might have impacted the family. So somebody had a gambling habit or something that really ended up impacting the family finances, and you were aware of it as a child. And so I think knowing where we come from, not just how much money we had as a kid, it's more of the conversations and the observations that we come with. And so I think the other thing is whatever our parents did not specifically teach us about money, we really get through observation. So again, we see, is there stress in the home? Are mom and dad fighting? Do we have more money than my friends? Am I going on vacations that my friends can't afford? Am I doing things like Melanie said? My friends want to go do things and I can't afford it. My parents say no. That impacts me as a child. So I have all those things kind of in my head as I'm getting together with somebody who came from a totally different background. And so I think maybe one of the questions to start with is when you get to the serious part of the relationship, what did your parents teach you about money? What were your earliest memories? I think kind of thinking about what was the first time that you realized what the value was of money or the fact that you had money or did not have money. What are those things that kind of really stick with you from childhood? And then knowing that when you're coming together with somebody to combine finances, you need to understand your own backstory as well as their own story and then figure out how you're going to really manage things together. So I think that's a big part of it. I think the other thing that's, I guess, I'm going to say a relatively newer phenomenon is that couples are getting married later in life now than they had in previous generations. So back in 1956, I went back to the U.S. Census Bureau. So in 1956, the average age for men to get married for the first time was 22 years old. For women, it was 20 years old. So people were getting married very, very young. Maybe that's even, right out of college or not even college, not even in college. And so now the age for men is 30 years old for a first marriage. And women, the average age is 28. And so I think when you think about yourself at 28, you've probably if you went to college, you probably graduated. You probably had a job or two. And so I think when you think about being that young adult now, combining resources as a couple, you've already had your own way of managing your finances. You probably already had a checking account if you're getting a paycheck. You already maybe had a retirement account that you started. So you've already got these ideas, you've already got kind of these systems in place. And so now you need to integrate that with a whole other person. So they already had their own system in place. If they're 28 or 30 years old and you're getting married, again, you've already done some of this. So I think figuring out how did I do things? How did you do things? How can we do things together in a way that's going to be productive? And I think getting to the point that you can agree on a system and really kind of have your own ideas of how you're going to move forward is really the most important step. So I do want to share, I think I have a slide to share. And this is something I wanted to kind of start with my presentation today, which it ties in with everything we've already talked about this morning, is really a quote from a book it's called Facilitating Financial Health. And this is something I read in my behavioral finance class in graduate school. So I don't know are you sharing that slide? I can't see it if you are. So, okay, perfect. I just want to read this because I really want this to soak in, okay? Because to me, again, this is really a very important detail. So money is inescapably interwoven into the fabric of our relationships, dreams, fears, loves, hates, successes, failures, and struggles. It's one of the few elements of life that has an effect on every aspect of existence, from meeting basic needs for food and shelter to satisfying the higher order needs related to the meaning of life and spiritual connection. And so, again, I think this is very important. I think really it's not possible to deal with finances as a separate part of our life. Money really affects all aspects of our life.
Yeah, and thanks for sharing that quote. That is so interesting to ask when you're dating somebody or getting serious. What did your parents teach you about money, or what did you observe about money? That is a great question that I've never heard being advised before. So nice. I'm sure that gets at a lot. So managing, as you talked about, managing your finances can be challenging enough when we're single, much less joint finances, when we're combining resources with a partner. So how should we approach that?
Well, so again, figuring out where they're coming from, what they've already put in place, and then also really looking at things like now you have a joint account to manage, most likely. And so I'm going to talk about some of the different strategies for, I'm going to go back to what Melanie said with the his, hers, and theirs. I like that concept. I'm going to talk about that in my last question. But now you probably have a joint account. Now you've got to decide on the joint account. What kind of an account? Who puts in money? Do we both put in equal? Do we have separate accounts? And then I think things like going back to what Brooke talked about, you're going to do your taxes together for the first time as a married couple. So, you think about who has the shoebox that has all the receipts in it, and who has everything super organized in file folders. I mean, I think you're going to have to figure that out and navigate it together because at the end of the day, even if you make different amounts of income, you're still liable for taxes together. And so I think that is something to be aware of. That's a good exercise for kind of figuring out how you're going to really manage everything as a married couple. So financial compatibility is something that's very important. And so I think the sooner the two of you as a couple can get on the same page with saving and spending, the better. There was a study I read on financial satisfaction, and this again, I think is probably obvious to any of us, was that most people don't disagree about investments made for the future, but they do disagree about spending maybe that wasn't agreed to, spending that maybe wasn't something that you were on board with, something that your spouse did that you didn't know about, or again, it can be the stress related to the car repair that's you got to deal with it right away. Some of those things you don't have money set aside that creates a lot of stress. So having that compatibility where you know what goals are that you're going to set out to achieve together. And then really what I like to encourage people, especially at the beginning of marriage, is to really create a long-term financial plan. So a financial plan is really just a roadmap. It's a way to show you where you're trying to go. Sometimes it's fun to just get in the car and start driving with no, I mean, used to be you had to have a map. Now we have GPS, but you get in the car and just drive. You decide who's going to drive, which direction are we going to go, where do we ultimately want to end up. You can do it and you can wing it, and you probably might get somewhere interesting, but you don't really know where you're going. And I think when you think about things like saving for college for future children, retiring together, if you don't have that roadmap or you're not working on that map together, you don't really know where you're going to end up. And so I think, again, obviously I'm a certified financial planner. I'm very passionate about planning, but I think as a couple to put those goals down on paper together is really one of the most important things you can do. And then I think the other thing I want to mention is just to be aware of debt. And so, people have student loan debt, vehicle loans, credit card debt. And so I think when you're getting together as a couple, being aware of not only your own debt, but your partner's debt and how you deal with that debt. When you come into a marriage, anything that you had in terms of debts prior to marriage is typically remains your own liability. So that usually doesn't get mixed up. And again, thinking if you potentially would get divorced. But after you get married, any debt you take on together typically is joint debt. And so the state of Wisconsin has some unique property laws I'll talk a little bit about. But I think the other thing too is, just knowing that if there is debt, you're going to want to have a plan to deal with it. Sooner the better. And maybe it's something that you can tackle as a couple that maybe was harder to do on your own.
Right. Yeah. So, so the legal aspects, let's talk a little bit about that. What should we be aware of when keeping money separate before and after we get married? And does the same things apply to those who don't get married but are sharing the same household?
Yeah, so that's another great question. And so again, just caveat, I'm not an attorney, I'm not giving legal advice. And so I think what I focused on, so in the state of Wisconsin, from what I could figure out, there really isn't the same protections and laws do not apply to non-spouses that apply to married couples. And so people who cohabitate or share expenses don't have the same rights as spouses do. And so really with spouses in the state of Wisconsin, you have basically what's called individual property, and then you have what's called marital property. And so individual property is what you come into the marriage with. Things you already own, the retirement account you already had, the checking account already in your name. That all really stays your own property unless you do something to mix it with joint property. But generally, it stays separate. And then anything that you earned during the marriage, wages earned, investments made, loans taken out, even if your name is not on that loan, typically that's considered marital because it was created during the marriage. And so that becomes only important when you think potentially you might get divorced. And so I will talk about divorce a little bit. I know we kind of I don't want to save some time for questions at the end, so I won't get too deep into that. But I think knowing, you've got the individual debts, you've got individual property. And so knowing what is what as you're going into a marriage is a really important point. Some people have asked me about, what if you are asked to sign a prenuptial agreement or something called a marital property agreement in Wisconsin. So the prenuptial, I guess I would say, if you get asked to sign that, or if you're asking someone that you're marrying to sign one, because it goes both ways, and it's something that you both would agree to. I mean, so I guess I would say it's best not to surprise someone with that. If you think that that's coming and the relationship's getting serious, you're talking about money and what your parents taught you and kind of where you're starting from. If you think that something like that's going to happen, it's better to talk about it, communication, and really kind of awareness of, why would we be doing this? And usually it's because there's some kind of family asset that parents or grandparents typically want to protect and sort of stay along family lines, if you want to think of it that way. So it could be that somebody inherited a trust from their grandparents, and that money is going to stay with that person. It wouldn't get mixed up with marital property because it was separate. And so things like that are usually why. Sometimes there's a business that one person owns, and that business really isn't a joint asset. It's something that's their own either family business or their own livelihood that they really need to keep separate. So there's a couple little tips on that. I just want to mention is what's called commingling. So some people may have heard this term commingling. So basically what that means is that you had individual property or premarital assets, and you can keep those separate. Or if you put them into any kind of marital account, again, the downside of that is that in the event you divorced, which you're hoping you're not thinking of that as you're just getting married, right? But in the event you do, again, you sort of took something that could have remained separate for yourself and you sort of made it joint property or marital property. And then even after marriage, if you receive gifts or inheritances, typically those also remain separate property unless you commingle them. So even if you're married and you get an inheritance, again, if you do it right, you can keep that separate and that wouldn't get divided potentially in a divorce. But then again, once you do get married, anything you really do together, whether you're on the account or not, typically is considered joint property. So I think just being aware, and I think this is where, again, when you're talking about family money, you can try to find out what accounts you have. Do you have things that are separate? Do you want to keep things separate? And there's nothing wrong with that. But again, I think being aware and not being caught off guard is the best advice.
Yeah, absolutely. Understanding the different not only options, but just not inadvertently doing something that you come to regret later. Like you mentioned, putting something into commingling that later turns out to be not a great idea. So you touched on the divorce piece. So when we think about, couples want to maintain financial harmony and avoid money conflicts. And so what are some of the best strategies that you've seen work well for your clients?
Yeah. So, I think the first thing I would start with for couples who want to, and everybody wants to maintain harmony. I think that's, very important for marriages. I think, again, kind of going back to what I started with was understanding the money scripts, how your partner was raised, what money, kind of what they tell themselves about money, because a lot of that kind of, as Melanie said, you can sort of tell yourself you'll never be good at something, or you can tell yourself, I'll never have wealth, I'll never be able to buy a house, I'll never be able to do all these things. You can tell yourself that, but then it's really hard to achieve any of those goals. So I think giving yourself the benefit and again, finding the resources, finding the people who are willing to help you get that education you never got at home, that's really important. And so I think resolving any differences early on in the relationship so things don't kind of linger, knowing that you come from different backgrounds. And so kind of trying to address that right away would be my first thing. I think the second thing is really creating a money management plan that works for both of you. And so this is kind of the system. Again, you both come into the marriage with your own way of having handled your accounts. What are we going to do together now that we're combining and we're married? And so Melanie talked about kind of starting small, sort of creating these habits that can reduce stress. So a lot of that can come into play when you're combining your accounts and combining your assets. So one plan that I see work really well is what's called the yours, mine, and ours, or his, hers, and theirs. And so the way this works for couples is you basically have a joint account that's for the household finances, and then you each have your own separate account that's kind of for your own expenses, but also is where you can go to the spa and spend what you want to spend and not have to talk about it, right? Because it came from my paycheck, it's my spa weekend, and it's my, it's my thing. And I think for a lot of women, especially getting married a little bit older, maybe having assets and being independent, before getting married at age 20, where you're pretty much either going right from your mom and dad's house to your, to your new home that you're getting married in. So I think knowing that you have the right to have that separate money, and there's a lot of benefits of doing that. And then again, you decide, and this is where it gets a little bit more complicated, is how do you put money into that joint account? So is it just, you each take half your paycheck, but then what if one of you has student loan debt or other liabilities that the other does, and it kind of how you mix all that together. But I think again, the coordination, the communication is really the main thing. And then I think the last part of it really is that long-term plan. And so I think knowing we're on this road together, we want to make sure that we can plan for our retirement and our children's education and our grandchildren and all the things we want to do as a married couple. And then again, remembering that money really impacts every single aspect of your life, and there's really no way around that. And so I think getting your plan in order from the very beginning is really the best strategy for harmony.
Yeah, there's just so much to this. And so I'm going to jump into some of the questions. And thank you, all three of you, Jen and Brooke and Melanie, for the great insights. And so one of the questions that that Jen, I think might be a good one for you to answer is, what steps can you take as a woman to safeguard your financial well-being before you get married in a community property state? You touched on a couple things, I think, but
Mhm.
you just highlight um, again for our audience.
Yeah, sure. No, and that's a great question. It's a great, and so I think part of it is, I like to use what's called like a net worth statement. It can be simple as a piece of paper where you write down, the accounts that you own, how the accounts are titled, what the value is of the accounts. And so I think kind of keeping track of that hopefully moving upwards, total of, here's how much money I have. And it's not something you necessarily need to share as you're kind of deciding if you're going to be with someone, but I think for your own benefit to know. And so I think looking at everything that you have on that list, and sometimes what people do actually is so I do this with some of my clients where we basically take a snapshot of that net worth statement for both parties before they get married. So that we sort of have this record of this is what I had before we got married. And so I think again, and then knowing if you have how the accounts are titled, beneficiaries, making sure you have proper beneficiaries. Sometimes when we get married, we change our beneficiary to our spouse. Sometimes if we get divorced, we forget to change them to somebody else. And that is a problem, and it does actually happen. So I think, again, taking care of your own financial future is really, again, knowing what you came into the marriage with that you can maintain separately.
Super, super, super. Okay. I'm going to go to Melanie. Melanie, could you share more about how to be equitable in managing finances when there's a major disparity in wages? I hear that a lot where, how much, how do I manage that when, I make so much more than he does, or, whatnot.
Yeah, absolutely, Kim. And I think it's such a great question that has a lot of meat to it, honestly, and it requires a lot of communication. And I think right away, the first thing that comes to mind is, having an open conversation with your partner or your spouse and understanding the dynamics of each person's, income and expenses. And I've had conversations myself in my own marriage, but I've also had conversations with couples that have really needed to look in and understand each other's situation. One that comes to mind is that one might, be making $10 to $15 less than the partner, but they might have a lot more in student loan debt. And so they're trying to, do what they can to also get out of debt. But if they're equally paying 50-50, that can make it really challenging. And so when we think of that definition of enjoying life, that can actually restrict it when there's an uneven playing field. And so, I think it's just important to have the conversation to really sit down and document everything, just as Jennifer is mentioning and saying, here's what I'm obligated to, here's what it looks like for me. If we're looking to commingle, our finances together or set financial goals together, let's really look at this. And so, it really does take a deep dive into really understanding and having open communication.
Yeah, absolutely. Oh my gosh. All right. So, Brooke, I have a question for you around what common misconceptions about money or taxes would you like to dispel?
That's very broad.
Very broad. Yeah. Yeah. I'm sure there's a lot of them, but what might be one?
Um, well, I would say, because I'm in the tax world, I'm not going to dabble into the other part of the financial. I'm going to let the experts handle that. But from the tax side, you always hear some of the gimmicks out there of trying to not pay taxes, or I don't owe taxes, and somebody else can handle that. I would just say that I got into this because back in the day, somebody told me that there's only two certainties in this world, death and taxes. And I said, well, I'll always have a job. So just know if somebody's coming to you with a scheme about how to not pay taxes or lower your taxes, really take a good look at that before you get on board with that.
Yeah, bad idea. Um, all right. Let's see. So, Melanie, my husband and I recently got married and want to combine finances. What would you say is the first steps? And Jen, if you want to jump into this question too.
Yeah, well, congratulations on the recent marriage. That's exciting. I would say with this one, similar to the former conversation with Kim, is really understanding each other's financial picture and knowing what that looks like. And that might even, be getting out either a blank piece of paper or even a Word document where you're starting to itemize and list out each of those things. And it might even involve establishing a new account, where Jen talked about the his, hers, and the ours, or having a conversation around that. But then it starts with the tangible things of deciding how much it would be per paycheck that you'd be contributing to a joint account, or if you're moving everything over, what it looks like for switching automatic payments, what it looks like for having conversations around spending, right? Spending, giving, long-term financial goals. And so there's a lot of pieces that go into that combined finances, and I'll let Jen add on to that.
Yeah, so no, I mean, I agree with all that. And I think those are all really good tips. I think part of it too is I think, thinking about now being married, again, I would focus also on the longer term. What do you really want to accomplish together? And sort of what legacy do you want to leave? Kind of what are you all about? Because a lot of it is, especially when you're just getting started, this is sort of the tactical, like we need one checking account or we need three checking accounts. So you kind of get through the level of we've got the basics covered. We're filing our taxes. We're doing all the things we need to do. Now, what do we want to do? And so I think a lot of times for some couples, that's when you start talking about having a family. It's like, well, let's dream about the kids we might have someday and the college you want to send them to. And, they're all going to go to Harvard and get full ride scholarships and be super athletes. And that doesn't always happen. And so I think knowing, again, the more of that conversation you can have together, especially as a young couple, planning out I mean, that to me, that's just a great phase of life. So I think knowing the resources available, kind of how you get this planning started. You can hire a financial planner. A lot of it you can do on your own. A lot of it is really just kind of figuring out the dreaming part of it. What do we really want to accomplish? Then you can get in, what accounts we set up to do it. How do we start saving for specific goals? So,
Super. Okay, for all three of you, I think all three of you could add your own perspective on this. And that's, do you have an example of one simple habit someone could start today that would reduce financial stress? And some of you went, you went over this within the presentations, but if I'm in the audience and I'm saying, okay, all of what you've said is fantastic, and I've got a lot of things swirling around. Where should I start from each one of your perspectives? What's one thing I could do? So, or two, if you've got two. So, Brooke, you want to start with that?
Sure. I love Excel. I live and breathe in it every single day. And I would just say start setting your budget up in Excel. Figure out what you owe on a monthly basis on the dates you owe it. And I even track, you get paid on this date and these are the expenses I pay through that. And then you kind of fill out your whole year or month, like Melanie was saying, and you can say, okay, this is what I want for my savings. This is what I have after every net paycheck. And then you can do yours and then you can do the combined. So I would just advocate for Excel and a budget.
Yeah. And that's an easy way to look at it, isn't it? And, I think with all the streaming services and the Amazon lets you put the subscribe thing on things, I bet we'd all be surprised at how much money we have going at some of those things, and maybe had it in one time and then don't use it anymore or whatnot. All right, Melanie.
Yes, I would say for me, what comes to mind, it's more of like the awareness of spending and the impact it has on our emotions. So when you're doing transactions or you're spending and you're kind of reviewing, how are you feeling? because that financial wellness comes back to the money, the mental health, and all of those things that we've talked about. And so is what you're doing creating additional stress? That would be the first point to pause and then really do some reflection. And then the other tip that I was thinking about is I'm a huge proponent for the two checking strategy. Like there is a checking for bills and there is a checking for spending, and it's a great way to electronically budget. I love the spreadsheet, Brooke. I do have that, and that's more of like an annual review for me. But it is a game changer when it comes to having peace of mind, knowing that you have strategies in place that automatically flow every pay period into the bill account and that your bills are covered. And when you're operating out of one account, that can actually, or one account and you have two people maybe using it, that is another thing. That can create a lot of stress and anxiety as well. And so I'm a huge proponent for the two checking.
Excellent. Okay. Jen?
Yeah, so I would say make it automatic and make it easy. So I think part of it is so anybody who's in a 401k or any kind of plan that automatically takes money out of your paycheck before you can spend it, that's the best way to really build wealth. And so I think even if it is you want to set up an emergency fund, which I highly recommend. So again, when the car repair happens, you both put money into an account that you can access easily. So that might be $50 a month or $25 a month that you can take out of every paycheck to start building that account. Same thing for retirement, and then same thing for other goals. And so I think when you don't see the money and you don't have to consciously decide, am I going to invest this month, but it happens automatically. Nowadays, it's much easier to do that than it ever used to be. You can set up an auto contribution to almost any kind of an account, and you can start with a really small dollar amount. So even for the college savings, we talked about the 529s Brooke mentioned, for a newborn baby or even a baby not born yet, $25 a month, when that child gets to college, you're going to have a substantial balance in that account and you barely feel it when you start small. So I think that's the best advice is don't overthink, just get started at a small level.
Oh, yes, I love all of that. And the one thing I would add is that, online shopping is such a big trap. And, I'm guilty of it as much as anyone, probably more so in a lot of ways. And one of the techniques that I started doing a few years ago was putting things in my shopping cart and then waiting a day to maybe a week. And it's amazing how many things I actually don't really need when I go back there, or in some cases, depending on the merchant, I might not go back at all so kind of getting us out of that reactionary, oh, I really want that kind of thought process when maybe you really don't in a week. Okay, I'm going to end with this last question. Do you have any book recommendations on financial health wellness you recommend specifically for women, or do you have a recommendation or a referral, or like what kind of resources are out there for people?
You can go
Melanie,
first.
yeah, go ahead.
So the one that I got on an audiobook, so you can just listen to right when you're in the car, is The Financial Feminist. And so I liked that one a lot. And it's an easy one to listen to and kind of pick up. I'd say with anything, you pick up what you want to. And the more you hear different ideas, and the more that you hear what everybody else is doing, not everything's going to work for you, but you can pick up one or two things from anything. So audiobooks are great for the car. Podcasts are great for the car. Those types of things is what I would really say.
Excellent. Jen,
That's where I was going as well, actually. Brooke took it right from me. I've listened to Financial Feminist also on podcasts. It's just nice to kind of replay back, and you actually can go through and sort through the different topics to see what would be of interest as well.
Oh, wow, double recommendation. All right.
Yeah, I think there's also a podcast called Financially Fierce. I think that there's a Financially Fierce podcast as well that I've listened to. I guess the one thing I would say when I started learning about personal finance, this may date me a little bit. So like I used to buy like personal finance magazines. So you go to the grocery store checkout line instead of like, People magazine, I would look at the personal finance magazines. And so I think some of those still have some pretty good info for just getting started. I think the internet is a great resource, but you also need to be really careful who you're talking to, who you're following. There's not everything is 100% true. And so I think, finding people that you can trust. And I think if you, again, really want to embark on financial planning in a serious way, I would find an advisor who can really walk you through that and help you and educate you along the way as part of the process.
Oh, all really great. This is so wonderful. Thank you all so much for being part of this panel. It has just been, the time has just gone by so fast, and we've learned so much from all of you. Really appreciate it. And I think it's such a great topic, given that one of the United Way's main one of their four main areas that they really focus in on is financial security. And so this topic is just something that we all work with and work through. So all right, now I'm going to turn it over to Margaret, and Margaret's the vice chair of the Women United, and she's going to close out with some messages of her own. Thanks, Margaret.
Thanks so much, Kim. Thank you to everyone who participated today. Thank you so much to our three panelists, Jennifer and Melanie and Brooke. I have a full page of notes here that I took, so really grateful for all the advice. While I'm going through last minute closing items, if anyone else wants to share a tip or two they took away from today, that would be great to share all those. Any other advice or things that stuck in your brain here. I wrote down both the podcast name and the book. They'll definitely be looking those up. So thank you so much for everyone's participation. And Molly is also going to be dropping a survey in our chat if you have time here in the next few minutes or later today to fill that out. We really welcome the feedback to make sure that we're providing this kind of panel and any other events that really speak to what our community is looking for. So please take the time to fill that out. Just a couple questions for you. Thanks so much to our Women United team who put this together for us. Another great one, at least as long as I've been participating. So I'm very excited for that. And if you've enjoyed today, please make sure to reach out to any of us Women United members for more information on how to participate, and follow us on LinkedIn for up-to-date information about events and how to join, how to be involved. So really hope you all took away as much as I did from today's panel, and we're again so grateful that everyone participated. So with that, Molly or Leah, anything else I'm missing? Otherwise, we'll make sure that survey is in the chat there. Yep, I see the link. Otherwise, we will wrap up for today. Thank you so much, everyone. Have a wonderful rest of your Tuesday.